Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Aluminum Corporation of China Limited Annual Report. Aluminum Corporation of China Limited, CHALCO, is a diversified conglomerate with a wide range of businesses and services. The company operates through 5 main segments: alumina, primary aluminum, energy, trading, and corporate and other operating. The alumina segment involves the mining and refining of bauxite into alumina, as well as the production and sale of refined alumina, gallium, and multiform alumina bauxite. The primary aluminum segment includes the procurement of raw materials and electrical power to produce and sell carbon, aluminum alloy, and other electrolytic aluminum products. The energy segment is involved in coal mining and the generation of electricity using thermal, wind, and solar power sources. CHALCO also manufactures power-related equipment and trades in alumina, primary aluminum, and other non-ferrous metal products. The trading segment provides logistics and transport services to external customers. In addition to these core businesses, CHALCO is involved in various other activities such as research and development, engineering projects, thermoelectric supply, investment management, import and export, and the manufacturing and distribution of anode and cathode carbon products. Overall, CHALCO's diverse range of businesses and services make it a significant player in the global aluminum industry. The company's extensive portfolio includes bauxite mining and refining, primary aluminum production, coal mining, and electricity generation, trading of alumina, primary aluminum, and other non-ferrous metal products, logistics and transport services, research and development, engineering, projects, thermoelectric supply and investment management, import and export activities, manufacturing and distribution of anode and cathode carbon products. Aluminum Corporation of China Limited market capitalization of $203 billion is significantly larger than the average industry peer of roughly $19 billion. This shows that Aluminum Corporation of China Limited holds a significant advantage in their industry. Aluminum Corporation of China Limited trades at a higher price-to-earnings ratio of 12 times and a higher price-to-book ratio of 2.24 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The company maintains a moderate leverage profile, with liabilities making up 48% of total assets, suggesting a balanced approach between risk management and capital efficiency. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. Although shareholder equity has increased, the share count has risen while revenue is declining. This raises concerns that equity growth may be driven by dilution rather than business performance. The sustainability of the business model remains unproven. The company have a dividend yield of 2.59%. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline can be identified through an analysis of various factors. On the one hand, revenue growth is often attributed to increases in trade receivables, sales of goods and services, introduction of new business units, and investments in associates and joint ventures. For instance, the sale of goods and services to companies such as CHALCO and Yunnan Aluminum contributed significantly to revenue growth. On the other hand, revenue decline is often driven by decreases in trade receivables, sales of goods and services to joint ventures, and purchases of assets from related parties. The decrease in trade receivables over a 3-year period was a notable driver of revenue decline. Additionally, changes in depreciation expenses can also impact revenue growth or decline. It is essential to note that each business unit or segment may have its unique drivers of revenue growth or decline. A segment-level analysis highlights the performance of specific business units or segments, while geographic variations in revenue growth and decline are also reported for different regions. Overall, understanding these primary drivers can provide valuable insights into a company's financial performance and inform strategic decisions. The net income of the company underwent significant fluctuations over time. Initially, it increased by RMB 209,869, followed by a substantial rise of RMB 12,587 million. However, there was no change mentioned in one instance, and a decrease of RMB 827 million in another. In terms of profit margins, the company experienced mixed results. The high-end transformation strategy, global layout optimization, and green development initiatives contributed to an improvement in profit margins. Conversely, market price fluctuations led to narrowing profit margins. Additionally, the storage and transportation services provided by CHALCO resulted in a decrease in profit margins. Regional variations also played a significant role in determining profit margins. Lanzhou witnessed a decline in its profit margin range, while Shanxi saw an increase. Qinghai experienced a slight decrease, and Guangxi recorded an increase. These regional disparities highlight the complexities of profit margin changes within the company. The company is generating positive operating cash flow, a crucial indicator of its financial health. This can be confirmed through various pages in the report, which consistently show that the net cash generated from operating activities is higher than the operating profit. On page 10, we see that the operating profit is RMB 25,805,893, while the net cash flows generated from operating activities is a significantly higher RMB 34,092,341. This discrepancy suggests that the company's operations are generating more cash than its profits would indicate. Further evidence of positive operating cash flow can be found on page 49, where it is explicitly stated that the operating cash flow is RMB 33.843 billion positive. Similar results are reported on pages 354 and 356, which show a steady increase in net cash generated from operating activities over the past 2 years. Additionally, pages 395-397 provide more detailed information on the company's operating cash flows, with all 3 sections showing positive net cash flows from operating activities. These figures range from RMB 8,432,323 to RMB 4,230,637, indicating a consistent and significant generation of cash from operations. Overall, the evidence presented in the report confirms that the company is indeed generating positive operating cash flow, which is a testament to its financial stability and ability to sustain its business operations. The company's debt levels have undergone significant changes over the past year. While non-current liabilities decreased by RMB 610,959, current liabilities increased by 10.7%. The total financial liabilities at the end of 2025 were RMB 99,517,781, a notable increase from previous years. In terms of interest expenses, there has been a decrease overall. Interest expenses decreased from 2,768,998 in 2024 to 2,351,191 in 2025, and finance costs net also saw a decline from 2,632,899 in 2024 to 2,104,026 in 2025. However, there are some exceptions. Interest expense on lease liabilities decreased by RMB 30,385, while interest expense on borrowings and discounted notes increased by RMB 16,011. Lease liabilities themselves increased by RMB 4,444,949, and long-term bank and other loans rose by RMB 28,439,672. Overall, the company's debt levels have increased significantly, with a notable increase in total financial liabilities at the end of 2025. While interest expenses have decreased overall, there are some areas where they have increased or remained steady. The performance of various segments and regions within the company has been mixed. On a positive note, the alumina segment, primary and other interaluminum segment, and aluminum segment have all shown strong revenue and profit before income tax figures. These segments have contributed significantly to the company's overall financial health. In contrast, certain segments have underperformed. The energy segment has struggled with low or negative profit before income tax, while the primary aluminum segment and other segment have also reported negative profits. Additionally, the marketing segment has seen low profit before income tax figures. Geographically, the Chinese mainland has experienced an increase in revenue, accompanied by a slight decrease in non-current assets. Conversely, regions outside of the Chinese mainland have seen a decline in revenue, but an increase in non-current assets. These regional variations highlight the need for targeted strategies to address specific market conditions and optimize performance. Management's outlook for the company is centered around improving profitability through strategic initiatives. The company aims to seize opportunities by reducing costs, enhancing efficiency, and accelerating structural adjustments. This will be achieved through investments in key projects, a reduction in long-term borrowings, and a decrease in debt-to-assets ratio. In addition to financial improvements, management is committed to environmental sustainability. The company plans to strengthen environmental monitoring, promote green mines, and increase new energy usage. This focus on sustainability is part of the company's broader strategy to win the battle against pollution. The company will also closely monitor policy and market changes, adjusting its investment strategies accordingly. This includes controlling project investment pace to ensure reasonable growth. Furthermore, management has identified a key competitor in Yunnan Aluminum and aims to address horizontal competition through various means by 2028. Overall, management strategy is focused on driving financial performance while prioritizing environmental sustainability and adaptability in response to changing market conditions. The company has a history of paying dividends to its shareholders. This practice demonstrates the company's commitment to returning value to its investors and rewarding their loyalty. The payment of dividends suggests that the company has generated sufficient profits to distribute a portion of them to its shareholders, indicating a stable financial performance. A review of various pages in the report reveals multiple instances where dividend payments are mentioned, further emphasizing the company's consistent approach to dividend distribution. This practice is likely to continue, providing investors with a steady source of income and a measure of stability in their investment returns. Concerns about inventory buildup and supply chain disruption. The company is facing potential issues related to inventory buildup and supply chain disruption. On page 141, inventory buildup is mentioned as a concern. Furthermore, data on page 311 reveals that raw materials and finished goods inventories have increased by 11.3% and 9.8%, respectively, while work-in-progress inventory has decreased by 10.6%. This trend suggests that the company may be accumulating excess inventory. Additionally, the purchase of inventories in relation to trading activities has decreased by 21%, page 340, indicating a potential mismatch between supply and demand. However, this decrease is accompanied by an increase in inventory impairment loss, which could indicate that the company is struggling to manage its inventory levels effectively. These concerns collectively suggest that there may be issues with inventory levels or supply chain disruptions affecting the company's operations. That concludes the financial summary for Aluminum Corporation of China Limited. Feel free to comment below, and I will be happy to answer them when possible.